Welcome to the IRE.IQ Quarterly Fundraising Report review. Thank you for joining us for a look at closed-end real estate fundraising activity as tracked by our IRE.IQ database. We'll be sharing some trends and data covered by our Q1 2025 IRE.IQ Fundraising Report, which was published Thursday, May 8th. Today, I will be joined by a pair of industry experts to discuss the broader trends affecting real estate fundraising and where the market might be headed. I'll share a brief slide presentation with data and charts from the IRE.IQ fundraising report, and then we will have a broader conversation about fundraising. We also will be answering questions from the audience through the Q&A feature, which you can access at the bottom of the screen. Now, all the data discussed in the program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contracts, and it has tracked more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IRE.IQ as part of their benefits package, but if you are not a sponsor and interested in using IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. Now, I'd like to welcome Seth Marcus of Townsend and Jay Struzziery of AEW. Hi, Seth. Hi, Jay. Thanks for joining me today.
Hi, Loretta.
Hi, Loretta. Good morning. Thanks for having us.
Great. So the first thing I'm going to do is I'm just going to have each of you give a brief overview of your role and where you sit in the fundraising ecosystem and what perspective that gives you on the market. And so I'm going to start with you, Seth, and then I'll go to you, Jay.
Sure. Well, thanks again for inviting me to participate as a panelist here. So I've been at Townsend now for 17 years. And the quick math on that is means I started back in the teeth of the GFC in April of 2008 after a few years in banking. So I've seen quite a different fundraising environment over that time frame. However, Townsend's a global platform with about 30 years of investment experience and knowledge, and we are an investment advisor and manager and advised capital of about 233 billion of assets under advisement, another 20 billion of assets under management. We work with several types of institutional investors globally, with my focus mostly on U.S. clients. These partners, and I refer to our clients as partners, vary significantly in sort of size, scope, and strategies, but the majority of them have mature, diversified portfolios across risk, return, geographic, property type spectrums. Maybe most importantly to this conversation is since 2004, so about a 20-year history, Townsend and our clients have committed about $230 billion to more than 1,500 different investment positions. And this includes newly launched open-ended funds, secondaries or non-traditional properties, secondary recaps, JVs, co-investments, and platforms. And that's deals closed. So we see obviously a lot more than that given the vetting process. And this depth and breadth, and why I state these statistics is as important, is because it often makes Townsend the first stop for managers raising capital. So we see firsthand virtually every institutional offering that comes to market. So much like the great information that IRE.IQ puts together, we also have an internal database for our partners and have over about 650 funds open and actively raising capital today, seeking north of $500 billion of non-core dollars. So helps us give a perspective to our client base and to the institutional investor universe.
Thank you, Seth. And Jay. Same question.
Okay, thanks. So Jay Struzziery, part of the global investor relations team at AEW Capital Management. I started my career in real estate investment management in earnest back in 2004. So echoing Seth's comments, it's been an interesting ride, that ride up, that ride down, and everything in between, taking us till now. So for those of you not familiar with AEW, we are a global real estate investment manager. We've been around for over 40 years. Between AEW and our European affiliate, we have 85 billion of assets under management on behalf of over 1,000 individual and distinct clients. We are active across the risk return spectrum, core through opportunistic, sector specialty, credit and lending, as well as an active listed real estate securities platform as well. In terms of where I sit in that aspect of it, we're a global organization, and we have a team of investor relations professionals that assists our investment teams and other functional areas of the firm from North America, from Asia, and then with our affiliate in Europe as well.
Great, thank you. Thank you both for being here. We really appreciate it. I'm going to start with sharing my screen and sharing some data from the most recent fundraising report. All right, hopefully everyone can see that. Now, I just want to mention and thank you to our panelists. So what we're looking at, and I just want to sort of emphasize this, we're looking at closed-end funds investing in direct properties equity or real estate debt. Now, for this current report, we're sharing data on funds with a final close between January 1st, 2025 and March 31st, 2025. And, keep in mind that this is data that is locked in in the record here as of the time of final close, even though the fundraising will have gone on for, several quarters prior to that. And it is important to remember that this is just a snapshot in time. It is possible additional funds have closed during this period, but haven't announced yet. And our IRE.IQ team learns about they learn about these fund closings over time, and we update the database constantly. So, we're constantly updating as this goes on. But I still think that the overall trends can be useful and can indicate what's happening in the market and give some guidance to investors and managers about where we are and where we might be headed. And I will remind the audience again, if you joined a little late, you can post questions to the panelists through the Q&A feature at the bottom of the screen. You can also just post questions about the data itself. My IRE.IQ colleagues are here to answer some of your more technical questions about the data set in writing, whereas I can pose some of the broader questions to our panelists to get their insights. So with this first slide, what we're looking at here, $43 billion was raised by 25 funds holding a final close in Q1 25. And that is significantly more than the $11.5 billion raised by 17 real estate focused funds that held a final close in Q4 2024. So, keeping in mind that this is funds closing prior to the beginning of April, what do you think contributed to the upswing in volume at the beginning of the year? And maybe I'll start with you, Jay, and then I'll go to Seth. So Jay, from your position, what do you think might have contributed here?
Yeah, so like you mentioned before, a lot of these funds either soft launched or fully launched prior, obviously, to Q1 25. A lot of the launches were coming out of some of the initial volatility, confusion, and uncertainty that came with the interest rate and geopolitical environment that we're in 2022. And so I think that so some of these funds were raised quicker than others, but I think that a lot of it is just the buildup of the capital raise coming out of that period, which really started in 2022. And the other aspect of it here too is that in terms of the actual dollar volume, you do have a couple of funds whose names we don't need to mention, I guess, but who are a very substantial portion of the capital that was raised.
This is true. There are a couple of mega funds that have definitely contributed to a bit of that upswing. But even still, we had a couple of very slow quarters in 2024. Seth, would you say, looking at as you said, you guys track your own data, does this more or less line up with what you guys have been seeing?
It does, Loretta. And I think there's two other points I'd like to make that embedded in Jay's comments were that there's just pent up demand. Right, 2024 was one of the weakest or lowest fundraising sort of vintages in a long time. Something we track in our data is not just the amount of capital raised, but how much capital is being sought after, right? What's that top line number that's being targeted by capital raisers or funds? And going back to sort of 2018, on average, 70% of capital being sought after was raised. In 2023, it was down to like about 47%. In 2024, it was sub 40% of capital being actually raised of dollars being seeked out. So I think a lot of investors and GPs were slow to close and extended their fundraisers, and allocations ended up being below target because equity markets, were having some consistent gains and being under allocated. So they were resuming commitment activity. So I think that's the primary reason. The secondary is that at the same time, there was much more positive market view entering the year or finishing up the year, back in December, January timeframe. That view's obviously, shifted, and I'm sure we'll get into that. But entering 1Q sort of post year end, views were that real estate has maybe seen the worst of it. The tide was turning. We had seen a couple flat or positive quarters out of an Odyssey type return, and valuations seemed to be a little bit more appropriate. So buyers and sellers were transacting, and this really led to just more investor confidence to commit capital to a new opportunity.
Another thing that we were being told, let's say 4 months ago, when or maybe even 6 months ago, when we were asking, like what is holding investors back from getting into this market, one of those issues was they weren't getting the capital distributions, they weren't getting their capital back from their previous investments. Did that shift a little bit in Q1, Seth? Did we see more more return on capital so that investors then had the availability to move out again?
We did. I thought we saw a bit of an uptick in transaction volume. Don't think it was very long, a long time frame there, unfortunately. But you're right. There's a couple other factors that play into this, right? There's the inputs into these capital raising environment is the transaction market. It is liquidity and amongst whether it's open-ended funds or just transaction activity, I guess said again. But those contributing factors, have tailed off here in the last maybe 60 days as we've experienced. I think the one part that maybe is overlooked is sort of the OECF redemption activity. So I know this is a closed-end fund report, but it's an input into the whole calculation here. So you have OECF redemption queues totaling 12 or 13% of the index, which is about $38 billion, with average payouts in the 5 to 15% range. So liquidity is getting locked up in those positions, and now some of that capital will ultimately be needed to pay beneficiaries or pay necessarily liquidity sources, and some will be rescinded, but a significant amount of that would likely have been used to rebalance and commit to non-core dollars and upgrade portfolios potentially. So this isn't a referendum on open-ended fund redemption or liquidity activity. That's a topic for another webinar, but it's important that think about the capital raising in that mindset too. I think, to your direct question, right, transaction activity was down 60 to 70% from peak levels, and by most accounts, it did increase here in the first quarter a bit, although tailed off towards the end.
Anything to add here?
Yeah, I would agree with all that sentiment. Going back to and yes, transaction activity was higher in the first quarter. But going back to the OECF comments, whether it's Odyssey or some of the Core Plus funds, and also going back to Seth's earlier comments around a sentiment shift last year, one of the first things that I think that the whole market was able to observe in 24 was you saw a pretty big uptick in Odyssey secondary activity. Really around the 331.24 NAV increasing with the 630.24 NAV, and then you sort of saw that bid ask starting to close once you got to the September 30 NAV last year and the 12/31 NAV at the end of the year. So I do think that there was some more liquidity, but also a lot of good momentum that had been building to leave us with a relatively strong Q1 25 earlier this year.
So So of course, let's point to the elephant in the room, which is tariffs and things that have changed maybe since this data. You know, we were of course looking at Q1. Early April, just after the close of the first quarter, the Trump administration they announce and then they partially reverse these sort of sweeping tariffs on US imports. This has a huge impact on markets around the world. That the uncertainty of that and the sort of shifting sands of the tariff conversation, it continues even yesterday. I think there was some big movement there with a 90-day sort of pause on the highest of the Chinese tariffs on China and reversal. So, not that the tariffs specifically are having a huge impact, but one thing that we heard at our editorial advisory board was that this is causing some investors to go into more of a pencils down kind of position. So what are your expectations for closed-end real estate fundraising going forward, Seth?
Difficulty. Maybe said best. What was was it Rocky 3 when Clubber Lang said pain? I think that like uncertainty and the volatility really breeds both confusion and consideration, reconsideration of what you maybe thought you knew yesterday, and that's the environment we're in today. That I think pencils down is maybe not the right approach. I think continuing through the process, continuing to do your work, but really taking a really hard look when it comes to signing subdocs, closing, evaluating seed positions if they exist versus a blind pool fund and things like that. It's just going to take a lot more time.
Jay, anything to add here?
Yeah, I mean, I would say that it's hard to have visibility going out, 2, 3, or 4 quarters. I think beyond that, I think that things will settle. There's some recession risk that's out there, although it looks like, just in the last 48 hours, a lot of the economists feel like that's maybe come down a bit. But to Seth's point, there's a more defensive posture, I would say, right now. At the end of the day, everyone on this call listening knows this. There's a ton of work that goes into the underwriting, due diligence, into the memo, into the investment committee process. As our clients are going through that and thinking about what they can get through investment committee, times like this, turbulent, volatile, uncertain times, are going to potentially raise the bar for what gets through, some of the more immediate committees. And there's a lot of work that's involved with that. So we're definitely starting to hear, people taking maybe a short-term pause, maybe not allocating quite as much capital as their pacing plan was telling them, maybe at the end of last year. But overall, I don't think that sentiment is negative. I think that there's some sort of latent positive sentiment carried over from last year that's still out there. That's our own feeling.
And I'm going to go on to our next slide. This is closed-end real estate fundraising by real estate debt funds as part of overall fundraising. So we did see an increase in real estate debt funding through the year. You can see that here. But what are some of your thoughts on real estate debt fundraising in the current environment?
I'll go first. Sure.
I was going to say, who wants to take that one?
I'll jump in, Jay. So I think it's difficult to bucket all debt funds together, but higher base rates have led to more action and interest. And I think again here, it is driven by maybe a large fund that closed during the quarter. But debt in general tends to be very situational, right? First mortgage senior lending is much different than opportunistic credit, but it is definitely a better environment than maybe the past decade. In this uncertain and volatile economic environment, right, debt funds can provide, if structured appropriately, more certainty around yield. Structure can protect against volatility. I think in our database, of U.S. capital funds, out there raising capital, about 15% are in that debt category, which is relatively significant. And I think in many cases, it remains difficult for LPs to sort of bucket debt and include it in their real estate portfolio. It's off benchmark risk typically with an Odyssey benchmark. What we've seen, and maybe leading to some of the successful fundraising, is we've seen partners sort of create a private credit bucket, and really it's just to capture all forms of private credit, including real estate. And when there's a dedicated allocation, when there's that target number, it creates action, it creates commitment amounts, and I think that's a newer phenomenon amongst clients that we've seen and work with.
Do you see, with that creation of a private credit allocation, that means, of course, that real estate debt is then competing against other sorts of private credit, other sort of private corporate debt. Is that, how does real estate compete in that environment right now? Is it looking kind of comparable, or does it struggle to compete with other private credit options?
Yeah, not really my expertise, Loretta, but I think it does hold up well across those other sectors, right? The fundamentals within real estate remain strong, and overall we continue to focus on the income return, whether it's credit or non, and that tends to lead well into the debt markets for real estate credit.
Yeah.
Jay, anything else to add on this?
Well, I would just say we agree that it feels like a pretty good environment for real estate lending. To your other question, there's been a lot of capital that's gone to direct lending, more on the corporate side. And, I think we'll continue to see that. I think that the environment lends itself pretty well to that also. But I think in conversations that we've been having, especially over the course of the last 6 to 9 months, there seems to be, a strong sentiment towards loans that are backed by hard assets, backed by hard relevant assets that actually have replacement costs, and looking at that a little bit different maybe than, relative to the direct lending as well. And we're hearing that in the traditional institutional space, but also in the wealth space, which has raised a lot of money for credit products, as over the last few years.
I'm going to go ahead and move on to our next slide, looking at average fund size. So we did see an uptick in the first quarter data, and that really does reflect a couple of very large funds that closed. Quite a few there were several mega funds in the final close. I believe there were 5 funds larger than $2 billion, a couple that together, were closer to $10 billion. So, while the average was 1.7, I believe the mean was closer to about $1 billion. So only about a half the funds were $1 billion or larger. Setting aside Q4, which was, kind of a bit of an anomaly, there does seem to be a bit more of a trend, though, toward larger funds. And maybe it's just that it's the largest funds that are able to get over the finish line. What are your sort of thoughts about, the trend toward larger funds? Jay or Seth, either of you want to jump in on that?
I'm happy to start on this one, Seth, if you want. I'll try to keep it short. I mean, generally, yeah, we think that this trend is likely to continue. Some of it's a function of maybe natural inflation over time, but also a good chunk of it is just the massive amount of consolidation and larger groups getting larger over the last several years, and we think you'll continue to see that as well. And it's not just sort of manager to manager consolidation; it's managers pairing up with permanent and semi-permanent capital, whether that's insurance or otherwise. And I think that will be part of it as well. And just generally investors obviously preferring, sort of the safety in numbers and the diversification benefits that the larger funds can provide. So yeah, I think any quarter to quarter going forward, it's hard to say whether or not that will drop or rise, but longer term trend, we think it will continue to rise.
Yeah, I'd agree with everything Jay said. I think the stat that continues to be posted around is that 20 funds can have raised about 60% of the global capital. So that leaves 95% of GPs lacking consistent access to institutional capital, which creating this consolidation is creating this environment that we're in. I'd agree that the deals are getting bigger. Plus, I think the emergence of some of these, let's just use data centers as an example. Data centers have to be big funds. These are massive investments that need to be made, and this the size of that is playing through into capital raising.
I think it's good. It's good you mentioned that the data centers. In fact, 2 of the mega funds that closed in the first quarter were data center specific funds. In which can all be seen in the fundraising report that we put out last week. And yes, these data center funds, a single data center can be $1 billion. So you're going to need to have a fairly large fundraising just to do that. And we're also seeing a number of these data center funds that are, they're kind of blurring lines between real estate and infrastructure. So, we track both real estate and infrastructure funds. We do actually track them separately. We actually have our infrastructure fundraising report coming out today. And so, split between those, data center funds fall into one or the other category, depending if it's more of a real estate focus or even if it's just by a real estate group versus more of an infrastructure focus infrastructure group. So, just the amount of capital being raised for data center investments is a big part of what's pushing up the overall fundraising and the overall fund size. I'm going to go ahead and go to the next couple, and I'll probably go through these next couple slides relatively quickly. There's not a whole lot to see in them. Here's our 12-month total based on where the capital is targeted toward. And as you can see, about half of the capital targeted toward North America, with maybe 1/4, little less than 1/4 each toward Europe, or in these sort of global multi-regional funds that are looking generally more opportunistically. If you look specifically though just at the first quarter fundraising, more than 1/3 of the capital was targeted toward European real estate, with another 10% aimed at Asia Pacific, which is a little bit higher than sort of the overall for the past 12 months. Not to get too deep into US versus international real estate, but do you have any sort of impression on how maybe the tariff conversation is affecting perceptions about investing internationally versus domestically? Seth, when you talk to your sort of clients, do they have more concerns about going international, or are they more attracted to that right now?
Sure. I think international for U.S. domiciled investors always had a very, very high bar. Taking on that additional sovereign risk, we'll call it currency risk, needs to really be elevated kind of on a risk return spectrum. So if you would have asked this question in December or January, definitely with a home country bias, and I think we still generally do, but I think that where sentiment has changed a bit is areas like Europe that have largely kind of navigated the tariff environment so far pretty well, and the opportunity set there seems to be resonating across our client base, and the groups that are investing in those regions are also there's in our tracking tends to be more I guess kind of in their fundraising cycle are back in market here in the first quarter. So I think there's going to draw a little bit more attention to Europe, where historically it's been a low growth kind of environment. But with the volatility that's entered the market here in the U.S., I think that's going to drive a little bit more just focus today.
Any other thoughts on this, Jay?
Yeah, no, I would agree with that. There definitely seems to be an uptick in sentiment to Europe, absolutely, and on a relative basis compared with Asia Pacific. And we continue to believe that particularly for the largest of investors, who are looking at a balance of return and diversification, it still makes sense to invest internationally. But if it's more of a bespoke or sort of rifle shot investment, then it's just important to make sure that you've got the right manager, and you understand too, that all of these countries are different. The jurisdictions are pretty different, particularly in Asia. And yeah, so sentiment in Europe, I would agree, is higher. And a lot of people have been much more domestically focused for the last several years.
And we have a question from one of our viewers about whether these numbers include co-investment amounts, and I would say it depends. It depends on whether those co-investment totals have been announced at the same time that they were talking about their closed-end fundraising, in which case we do include those numbers. But if they were not announced at the same time, it might not be included. So I guess the only answer I have for you is sometimes. But that does sort of maybe ask a question sort of just generally, Seth and Jay, have you seen more or less interest in co-investment at this point in time, or more concerns about some of what's happening there, Seth?
We've definitely seen an uptick in interest. I think it's seen as a way to control the outcome a little bit more and control your weightings. Again, working with more mature portfolios, you can navigate where you may have a gap in your portfolio. Also, the obvious answer is to blend down fees too. Typically come at half fund fees or better than that from a co-investment standpoint. So definitely more interest in executing those structures. Now, navigating the sort of approval process is a different question, and case by case basis, but definitely interest in doing so.
Totally consistent with our observations, and I would think that if you ask most of the peer set, the people have probably done or offered more co-investment over the course of the last 4 years than they ever did in their firm's history. Be my guess.
So I've gone to our next slide. This is the sort of 12-month total investment style. And what I think is really interesting is that a year ago, if we pulled these numbers, we'd see a pretty even split between value add and opportunistic. And now we're seeing a pretty strong bias toward opportunistic. Just to kind of clarify again, this is, the closed-end fund universe does tend to focus on higher return strategies. So, I mean, it's not a surprise that we're not seeing any core listed here. A lot of that happens in the open-end fundraising. So this doesn't include those funds. And the funds that do not disclose a category, many of those are real estate debt funds, although it can include just sort of other funds that just chose not to disclose a strategy. In general, the way we, in the IRE.IQ database, talk about funds and their sort of fundraising, and we talked a little bit this in the sort of prep call, we tend to just, include them in the section where they are listed. So if a fund says, I am a value-added fund, it will be placed into a value-added category versus, sort of asking them to provide, well, what was your most recent quarter's returns, and, making that determination on our own, because that can actually give you a really lumpy and not necessarily in any better information. Turning specifically to these numbers, what do you think might be driving this bias toward more opportunistic investing in the past 12 months? What about the opportunistic, opportunity set is appealing to investors right now? I'll start with you, Seth, and then maybe Jay, if you have any color there.
Sure. I think it's primarily the expectation of distress, and what was being touted as a distressed environment for throughout the interest rate increase, kind of couple of years. Whether that's come to fruition or not, time will tell. But I think that these value add funds tend to operate in much more, I guess, or their time in the sun is when markets are operating efficiently, and markets have not been all that efficient over the last 12 months. So opportunistic preys on sort of the dislocation that hopefully presents itself to those individual strategies, and that leads to investor interest in those strategies as well.
Any color, Jay, if you want to add?
Yeah, I don't disagree with any of that. I think that some of what's driven that it's similar to what's driven a lot of interest in capital into secondary markets as well, for a lot of pretty similar reasons. And so, for us, stepping back at it a little bit, I mean, we tend to look at the non-core space in aggregate for some of the analysis, and the marginal dollar has clearly gone to non-core. We think that trend is likely to continue. We don't think that it spells the end of core investing. We think that there's still going to be a place for that, and especially with the repricing. But as capital also competes in a higher interest rate environment, we think these types of strategies are going to be more attractive to investors.
So I'm just gonna sort of pull up here's a summary of some key takeaways from the fundraising report's findings. I'm not going to go through each bullet, but I'll leave this up for a few minutes while we take some questions from the audience and work through any sort of other questions we might have. What are your thinking coming out of this, sort of this conversation and sort of the prep, what should our audience and the managers and investors watching this, what do you sort of expect this sort of fundraising to going forward? I know, Seth, you summarized it with the word pain. Do you see certain strategies or certain regions feeling more of that pain or less?
Yeah, I think it's real estate today within an institutional mandate has earned its position in a portfolio. So there's a baseline level of capital that needs to be raised, invested, and allocated, on a regular basis. And I think that, the majority of it, tends to, that we follow, or that I personally work closely with, is US domiciled here. So I think that's, we'll continue to feel, safer at home, despite maybe what changes out of Washington. But that means everything's on the table too. So when I said pain, I just meant, more just discomfort, right, around the environment today. It's not going to be sort of the one and done, closes and limited sort of time to negotiate terms. This continues to put, in my view, the investor, the LP, in a position of leverage to negotiate more favorable terms or governance rights or whatever they may be, given the just a slower fundraising environment. Maybe is a more appropriate way to describe it.
Now, I know both of you are really more focused on the US, so it's okay if this question from the audience is a little bit of a stretch for you, or if you don't have an answer. But do you see a difference in the investment appetite of institutional investors from different regions, whether North America, Europe, or Asia Pacific?
Yeah, yes, I would say that we do. I think that there's regardless of what region you're from, I think that there's a strong, at least for the capital that we see that's looking for an intermediary, there's still a strong bias towards the U.S., but I would say that a lot of it is driven by just cost of capital, too. And I think a lot of, our U.S. pensions, European peers, right, have a different cost of capital. It's generally lower. Canadian investors generally will have a lower cost of capital too, and so I think that creates somewhat more of a willingness to invest in Asia, historically to invest more in Europe as well, where it tends to have the opposite effect on U.S. investors looking to go abroad. That would be a very 50,000-foot comment, but
I will say, if anyone has additional questions about investor sentiment, we do put out a global investor sentiment survey. It just came out a couple of weeks ago. You can, talk to our data services group or look on our website for more information there. It does talk about some of those differences. Here's a question. Maybe I'll start with you, Seth. Are first close discounts enticing anymore? This came up at our board meeting too, so I'm curious.
Can I give the consultant answer and say it just depends?
I believe that some of the commentary that we heard at our editorial advisory board meeting was that it has to be significant and material.
Yeah, I think that's absolutely true. And discounts do not, grow. You can't grow your way out of or you can't discount your way out of a poor investment. So enticing, yes, they definitely, help you pick up the pencil and help, create urgency. What we've also seen is, a rolling discount, a rolling first close, I should say, where, a hard and fast date doesn't typically work in most people's process. But at the end of the day, like I said, you can't you can't discount your way out of a poor investment. So, final closes are also very, we're looking much more at final closes today than early first closes being kind of a seed capital source.
Yeah, I would say that they aren't what they used to be in terms of an enticement or an inducement, in that the definition of what they are, to Seth's point, where I think the market's morphed to more of a rolling first close concept. So the definition of what they are has changed, and then I also do think that their relative attractiveness just depends on the type of environment you're in. Are you in an environment that's a last look environment that Seth described, or you in an environment where you strongly feel you don't want a legacy position, you want a clean balance sheet, so to speak, and in that situation, the first closing fee break might be a little bit more enticing in a blind pool.
And I have a question I think we got into this a little bit, but maybe we can kind of dig into it a little bit more. Fund extensions, the question specifically, are the lack of realizations impacting making new investments? Is that affecting what's happening here? Seth first.
Absolutely, yes. This is the short answer. But we've, typically by a fund 3 or fund 9 of 6, whatever the math might be, if there's capital not being returned, it's becoming a detriment to fundraising from that specific GP and just generally the market in general. We said very, very bluntly to some groups that says, we'll give you capital when you give ours back. So it's now at the same time, we're not going to be a forced seller in this environment or when interest rates were bouncing all over the place, and we want the best return outcome from the managers, and that's what they're hired to do, and that's what they're trained to do. So I'm not nothing like a forced sale, but it does create a kind of a limitation and a reason to look elsewhere.
Well, and I think this comes back to some of the feedback that I had been hearing over the past 12 months is that it's hard to re-up with a group if you're not, getting some return from previous funds,
Yep. And multiples are becoming the new focus versus IRRs, right? I think that we can again.
Jay,
a whole other conversation. Go ahead, Jay.
Sorry.
Go ahead, Jay.
Loretta, I think your colleague Chase McWhorter was the first person I heard say that, but that DPI has sort of become the new IRR.
It's true though. It does seem to be the answer right now.
But to Seth's point, still have to have the performance at the end of the day too. Can't just be from fire sales and underperforming assets.
Well, and I think this kind of reads to sort of one of the maybe a little bit of a broader answer. What do investors need to see before they are going to become more active in their commitments to real estate funds? Obviously, they may have seen a little bit of what they needed earlier in this year. Maybe they're not going to see it now going forward, but what kind of questions are they asking as they look at real estate fundamentals or their portfolio? What's sort of driving their needs? What do they need to see, Seth?
I think it's a sense of a normalized transaction market. Will help. I'm sure there's several items, and I'm sure Jay will have a good perspective on this too. But investors really need to see sort of some consistent returns, some consistent valuation metrics, some just consistency out of that transaction market to be able to confidently act on new opportunities. We all track fundamentals. We know housing is a underserved property type, but with a lot of development coming online here, producing some pockets of oversupply. Similarly, across industrial, right? Those two have been the shining stars within the primary property types over the last handful of years. But fundamentals continue to be attractive in those sectors. It's just a matter of where the supply is being delivered and how it's being absorbed in those markets. But it comes back to that transaction activity, creating liquidity and generating sort of DPIs out of the existing positions.
Yeah, I agree with all of that. There will be certain funds that are attractive to fill certain gaps in portfolio allocations, whether, like Seth mentioned, it's something like housing or diversifying your housing portfolio as well. I think also, and it's tied into that the transaction comments, is I think when investors are comfortable that the portfolio fundamentals can sort of stand up to some of those capital markets headwinds on their own, really through NOI that should come from asset management activities. I think that's something that gives investors a lot of comfort, right? We've been in a market where capital markets forces have just overwhelmed what have been otherwise, pretty good fundamentals outside of a couple sectors, like office. And when it's a little bit easier to see that and underwrite that, in this market repricing, whether it's 19-20% in the core space, I think gives a little bit more visibility and a little more comfort around that for go forward returns, higher discount rates, and just general metrics for underwriting.
I do have a question from the audience that is sort of putting maybe the whole industry on the spot. Do you think the lack of liquidity from open-end funds is hurting the industry as a whole? And feel free to just say no comment.
I'll start as the sponsor of open-end funds. I think that market is pretty mature. I think that investors understand that in periods of illiquidity, they can be extreme periods of illiquidity. I think that most institutional investors are going to maintain a pretty healthy allocation to core. So like Seth said in the beginning, we've seen more rescinds. I think the Odyssey Index has seen more rescinds. I think the big core plus funds have seen more rescinds. But do I think that it helps having these queues in place? No, certainly not. But I do think that it's we here collectively really think that it's a lot different than the situation we had in the GFC, where investors were demanding liquidity at all costs, right? And they did not want to hear excuses from the manager in terms of why they weren't selling assets and creating distributions pretty much at all costs. This time around, a lot of redemptions come with, hey, is there a penalty if I rescind? Or, hey, you don't need to take a permanent impairment on our account here. We're hoping that we're able to rebalance at some point. Now, that's not the case in all situations, but if you look at what the average, at least of Odyssey, is in terms of redemption queue on NAV, I think it's something around 15%. Which means that 85% of the capital is staying put, at least for now. But with that all said, I'd go back to the earlier comments that I do think you'll continue to see a trend of marginal dollars going more towards non-core relative to the balance you've had in the past.
I am thinking, as you draw the comparison with the GFC, that was definitely characterized by more perhaps of a liquidity crunch than we are right now. Whereas perhaps now we're looking at more of a denominator effect issue. And so in those cases, a lot of LPs maybe can just sort of let it ride a little bit. We've got a target band, we can be at the upper end a little bit longer. Does that ring true to you or no?
I'll let Seth start on that one.
Well, I think I think today, to Jay's point, I think maybe getting into the sort of the comparison to GFC is yes, that's true, right? There's more flexibility today to withstand an illiquidity, environment, and the opportunity to redeem. Or I guess the back to the original question, right? What does this mean for the the overall industry? I do think that the illiquidity within the open-ended funds is presenting a problem. Don't know how I won't put a percentage on what that means holistically, but we've historically recommended and invested in funds that with the intention of holding long term. If you're in the open-ended world, they're not accessible. You can't invest when times are good, and you can't redeem when times are bad. So they're not technically, very liquid to begin with. And real estate itself is not a liquid investment opportunity. So many know that, but at the end of the day, they're structured to provide liquidity, and they should do so. There's several ideas out there to generate potential liquidity in these funds, whether it's hold them to a distribution or disposition strategy after X number of quarters of a queue. I also think that there was a time and place, and because queues began to increase even in 2021 and early 2022 when interest rates were still relatively low, and even at that time, I think the general consensus was, we're not going to pay out our full queue. We're going to pay out a smaller percentage, and that kind of leads to where we ended up today, having these significant queues. And you're right, Jay. 15% I think is about the average. I think it's come down a little bit. In the GFC, it peaked at about 18%, much lower dollar basis, right? It was a much smaller universe. But it was still, it's still a significant amount of capital that's seeking some level of liquidity. And I mentioned it earlier, right? It creates, in our portfolios that we help manage, we've looked to sort of trade up and rebalance appropriately. and sometimes you just don't have, you don't have the cash to commit. You need to rebalance through these redemption mechanisms, and when they're not there, it can be kind of detrimental to your portfolio.
Yeah, and I mean, I would just add on to that too. That's a great point. We think that there will be sort of a wider dispersion of success among these funds coming out of this period, right? If you were able to consistently make distributions, even if they didn't, they're not as high as initial expectations. We think that's going to make a big difference for some of these funds moving forward.
I'm gonna ask our final question from the audience before we wrap up. Continue on this topic. Has the recent expansion of secondaries in the open-end fund space helped alleviate these redemption queues? And do you see that continuing?
I'll start. I mean, I think it's helped. I don't think that it's enough to move the needle. It's a larger amount than what we saw when the queues first started building up back in 20 and 21. I think the volume last year was about 25% higher than it was in that period of time in the beginning. And there's been a couple large transactions, but it doesn't seem like it's a needle mover on that. Yeah.
Yeah, specific to the open-ended funds, right? Secondaries tend to be, limited in size, smaller transactions. Yes, you're getting it at a discount if you're, and if you think highly of the portfolio and the opportunity, then it's a great way to invest today. Really picking your spots and not going in at a primary fund commitment has been our recommendation for a number of quarters now, several quarters. I think secondaries in general, in the last 3 minutes, we won't have time to get into it, but are an extremely compelling opportunity today. And that did not exist when we referenced the GFC. There just wasn't that as much opportunity set at that point. I think, we think that secondary funds are here to stay and have a good, good track record and good kind of, forward-looking horizon to them. Much like, general private equity has been, a secondary, those secondary funds and opportunities in that sector have been prolific. And we're sort of getting there now. So I think that represents really an important, interesting opportunity, and focusing on your entry point again versus a primary fund strategy does help. But to the direct question, yeah, I think Jay said it right. It's not a needle mover given the size of and the quantum of capital that needs to be kind of redeemed or traded.
So, as we begin to wrap up, I'm going to go to each of you. Just, what are some of your maybe key takeaways for the audience about the current real estate fundraising environment and maybe what they have to look forward to? We do have a compliment coming from the audience. Great job, panelists, and thank you. So, thank you, anonymous attendee, for that little bit of praise. We love to hear it. Seth, key takeaways.
Sure, I think that sentiment changing in real estate's a long-term illiquid asset class. I think we all know that. Long-term investment horizons, institutional investors, tend to show impatience during times like this, but are typically very patient investors. We remind our partners, our clients, that we invest in real estate to earn income, to collect rents, which provides liquidity to pay beneficiaries, pay the needs of an endowment or foundation, and the appreciation gains and value gains that are a byproduct of doing a lot of little things really well. And all of that leads to the need to fundraise and create new institutional products. The other topic we didn't get into is really the institutionalization of new property types that is also feeding or filling the gap that maybe things like office have had in the past. So I think it's a bright future once we hopefully level set a bit and on the political side of the equation. And we do see attractive opportunities on a global basis.
Jay, key takeaways?
Tough to follow that. I would agree with we would agree with all of that. And we also are encouraged by the new participants that have been coming into the market as well, whether it's the wealth and taxable side, and potentially the defined contribution side. There's more talk around that. There's a lot of product development that's going to need to happen around that, but it seems like that's happening, and that's all very encouraging. So over the next couple of quarters, this is a pretty interesting time to be doing one of these panels. It's hard to exactly predict what closes and what doesn't, whether it's fund commitments or in terms of transaction activity. But we're definitely hearing more and more people talk about the value of replacement cost, right? There seems to be a directional view that, labor inputs, material inputs are going up. And if you're picking relevant assets, the right assets, that replacement cost is going to matter again. And we think that that's a real positive looking forward.
Thank you. Thank you all for joining us. I'd like to thank our panelists and our IRE.IQ data services team, especially Nico Pepis and Director Karen Palma, as well as the rest of my colleagues for putting together this information. As a reminder, all the data discussed in this program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contracts, and it tracks more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now, and seeking to raise a combined total of more than $500 billion from institutional investors. Publication sponsors of IRE.I receive access to IRE.IQ as part of their benefits package. If you are not a sponsor and interested in using IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. Our next IRE.IQ fundraising report review will cover second quarter fundraising, and the webinar will take place August 19th. Thank you all. Have a great rest of your day.
All right.
Thanks everyone.
Loretta. Hi, everyone. Thank you.